Here is a question with a 30-year answer. Both accounts receive the same monthly contribution, earn the same annual return, and run for 3 full decades. Neither performs differently from the other because both hold the same underlying assets. At the end of those 3 decades, both balances read the same number. The separation you might expect to find during the build-up does not appear at any point while the accounts are accumulating. Both grow in exact parallel from the first month through the final contribution. The difference between the 2 accounts surfaces the day you begin spending. When it does, the gap can exceed $100,000. The direction it falls depends entirely on your tax rate. Both the Roth and the traditional account can hold identical investments. Both follow the same market. Both compound at the same annual rate over the same number of years. The difference is not about investment performance. It is about when the government collects its share. A Roth account takes taxes up front. You contribute dollars you have already paid income tax on. The account grows free of taxation. In retirement, every dollar withdrawn carries no additional federal tax liability. A traditional account defers the tax. Your contribution goes in before it is taxed. You claim a deduction on your return for that year. The account grows without taxation during the accumulation phase. Then in retirement, withdrawals count as ordinary income and get taxed at whatever rate applies at that time. Both accounts receive the same monthly contribution and earn the same annual return. The only difference is the timing of the tax event, and that timing shapes the entire outcome. The comparison begins with 2 investors at the same employer. Both are 25 years old and earn the same salary. Each directs $500 a month toward retirement, as this forms the baseline for comparison. Both choose accounts which earn 7% annually. Over 30 years, the compound growth runs identically inside each account. After 3 decades of identical compounding, both arrive at the same balance. The number is $567,000. Most people expect the difference to appear somewhere during the build-up, whether from a hidden fee, a rate gap, or some mechanical separation. There is none, because both accounts follow identical investment rules. Both accounts accumulate in exact parallel, building identically over 30 years. The separation begins the day withdrawals start, when the different tax treatments finally diverge. When the Roth investor reaches retirement, the balance reads $567,000. Every dollar belongs to them outright, because the government collected its share on each monthly contribution as it was made. That obligation was fully settled long before retirement began. The traditional investor sees the same number on the screen, but a portion of that balance has never been taxed. The IRS deferred the collection, not forgave it. Each withdrawal registers as ordinary income for that year and gets taxed at the investor's current rate. The relevant question is not what the balance reads. The question is at what rate those dollars will be taxed when spent. Begin with the most common retirement reality. Your tax bracket stays the same across the 30 years. Both periods apply the same rate. 22%, identical brackets separated by 30 years. Several forces push retirement income upward. Delaying Social Security to age 70 increases the monthly benefit. Rental properties generate taxable income that does not stop, and future changes to the tax code introduce a variable no calculation can predict. Say the retirement bracket climbs to 30%. The 30% rate applies to all withdrawals. After taxes, the net payout falls to about $397,000. Including the reinvested contribution year savings, the traditional total reaches roughly $436,000. The Roth investor keeps $567,000. The difference comes to $131,000, clearly favoring Roth. The Roth investor receives $567,000, free of federal tax. The traditional investor holds the same balance, owes 22% on withdrawals. After applying that rate, the net take is roughly $442,000. That gap is $125,000. But the traditional investor was generating savings throughout the contribution years. Each month they contributed $500. They received a tax deduction. That deduction reduced their tax bill by about $110 that month. Set those monthly savings aside and reinvest them at the same 7% return. The additional balance grows to roughly $42,000. Add that back to the traditional total, approximately $484,000. The Roth remains at $567,000. Roth leads by about $83,000 at equal tax rates. Now consider retirement at a lower bracket. Once salary ends, spending often decreases as well. Taxable income can fall significantly below the working year level. Retirees drawing from savings and Social Security frequently land in a lower bracket than they occupied while working. Say the retirement bracket drops to 12%. The 12% rate applies to all withdrawals. The net payout reaches about $499,000. Add back the reinvested tax savings from contribution years, and the traditional total approaches $541,000. The Roth remains at $567,000. The gap narrows to about $26,000, still favoring Roth. The scenario most people overlook: the retirement bracket rises above the working year rate. Neither account wins in every scenario. The outcome reduces to one principle. Roth outperforms when your retirement tax rate exceeds your current rate. Traditional outperforms when your retirement rate falls below your current rate. When both rates are equal, the gap is small and in modest favor of Roth. That principle generates a practical framework. Investors early in their careers tend to benefit from Roth. Paying taxes early, before salary grows substantially, locks in a low rate. For most early career investors, that rate sits around 22% or lower. The lock-in happens when the price is at its cheapest. Investors at peak earning years tend to benefit from traditional. Taking the larger deduction now and paying a smaller rate on withdrawals later captures a real mathematical advantage. The trade makes sense when today's bracket reliably exceeds the expected retirement bracket. Investors who genuinely cannot predict which direction their rate will move have a third path. Splitting contributions between both accounts in the same year is permitted, provided the combined total stays within the annual contribution limit. That limit currently sits at $7,000 for most investors. Splitting gives up some optimization. The gain is flexibility and protection against both outcomes simultaneously. One factor the numbers alone do not capture: the Roth has no required minimum distribution. Traditional accounts require withdrawals beginning at age 73, regardless of whether the investor needs the income. For investors who prefer to leave the balance untouched and allow growth to continue, or who plan to pass assets to a younger generation, that structural difference matters beyond what any single calculation can show. The 30-year math does not produce a universal winner. It produces a decision rule. Your current bracket and your expected retirement bracket are the two inputs. If retirement pushes you into a higher rate, Roth wins by a meaningful margin. If retirement brings you to a lower rate, traditional delivers more after-tax income. If both brackets are equal, the accounts perform similarly, with Roth holding a modest edge. One factor the calculation cannot include: future tax law. Current rates are not permanent. A Roth contribution taxes the money at today's known rate. Traditional defers that obligation into a future environment that cannot be predicted. That uncertainty is a real consideration. Match the choice to what you can actually project. Tax rate direction, not account mechanics, is the variable that decides the outcome. If this comparison helped clarify the decision, subscribe for more long-form financial math. Drop a comment with your current tax situation, and we may model your scenario in a future video. Sources for every number in this video are linked in the description below.